So the $1,000,000 question for this entire video is, why do you hate on Alibaba?
If you take a company like Palantir, for example, it doesn't make sense it can still have this valuation when they still didn't show you profitability.
So welcome back, everybody. Today I have a special guest with me. So he's actually Stockado. So for those of you who haven't actually checked out his video, I'll leave the link in the description box down below. So I actually invited him onto the channel because I first saw his initial video about talking about whether everything money is wrong about Alibaba. Maybe before we go into the meat of the discussion, we would like to know more about you and what should my audience know about you, Stockado?
So thank you, Tay, for having me here, and I'm a big fan of your content. So my name is Sagar, and unlike what many people think, I don't have a financial background. I have a medical background. So I did my 6 years of medicine, and I decided to take a break because it's so intense. And I was already investing my own money when I was in 4th or 5th year of med school. And I say investing, I was just investing in 2 stocks. It was Apple and Fiat Chrysler, by the way. So nothing out of the world. And when I decided to finish medicine, when I finished medicine, I said, okay, so let me take a look. Let me see what's happening with investing because I like analyzing businesses. And so I said, okay, I'll start my YouTube channel as well, and I'll invest my own money. And that's how I started. Now, the YouTube channel I had before, I decided to sunset it because it was for emerging markets. And I realized I hit a ceiling there. Like I could make some changes. I wasn't growing as an investor, also as a content creator. And that's when I decided to start this channel, which is Stockado. And I don't have limits. You can see all my videos. They're all over the place. I keep changing the editing, bass, music. So it's not like my previous channel. It was really rigid. I was doing just analyzing stocks. It has to be point by point. Now it's like I post whatever the hell I want. It's mostly analyzing stocks, of course, but just instead of saying just, okay, I like this stock, I say, I don't like this stock. I hate this stock. I like this stock. So just to put some variations. And that's, I guess, when you found the Everything Money video, because that was like, I don't like this stock. Let me share it with everyone and let me see what happens.
Right. Actually, I also realized that something very suspicious, because currently your channel size, right? I actually noticed one of the channel plug, the silver play button at the back of one of the backgrounds. And more importantly, when I really look into the quality of the videos, the editing, how you portray yourself, it doesn't look anything amateur at all. So that really piqued my interest, which was why I also slid into your DM. And more importantly, because you dislike Alibaba, which was one of the main pointers on why I wanted to get you on the channel.
We'll talk about that. We'll talk about it.
Right.
So the plague is still there, by the way. And the channel, well, it did give me some experience because, you know, when we start like making videos, it's hard. Initially, it's very awkward. And then you still need to find your personality as well, because in editing, for example, now I add funny clips because that's just who I am. I like to make jokes, and finance is so serious. So why not play with it a bit? But in my previous channel, I couldn't do it because I had so many followers at that time. So it was like, no, I don't need to make changes because it's working. And now it's so small. I'm like, well, I can't lose anything. I don't have anything to lose. So let's just make changes. And that's how I started.
Right. It's a unique point, and it was what that got me attracted to the channel as well. So actually keep up all the different good work that you have.
Thank you. I really appreciate that.
Yeah. So maybe before we go into discussing about specific stocks, so I just wanted to look into or understanding your take on your own personal investment framework, or how do you actually analyze different companies? What do you look at in different companies, and more importantly, how do you navigate today's market as well?
Yeah, sure. So I'll divide this question into 2 parts. Regarding the investing process, there is no process. So I'm just freestyling because when I analyze a company like Micron, for example, which is a commodity, I can't compare it with a company like Microsoft because they are 2 different business models. So I just approach every business in a particular manner. And I have some filters, like I have the management, and I'll address that in the Alibaba part as well, because this is important. So I have management, business, numbers, and valuation. That's literally the order. I start with the management because if I take a business like cloud, for example, I don't have any experience there. My brother works there, so he can tell me how the industry is evolving, but I don't have any experience. So I'm betting on the fact that Andy Jassy or Satya Nadella, they'll do something and they'll innovate and they'll keep up the pace. So for me, it's very important that the management knows what they're doing. Then it's the business, then it's numbers and valuation. Just time to time, it changes with the business model, but that's what it is. And regarding the current market, well, I don't have cash. I can't inject more cash. I have some savings, but I don't want to inject cash because in my channel, I have a fixed number. So I want people to see how the portfolio is evolving. If I add extra cash, let's say right now it's 140,000, 150,000. If I add 20,000, which I can, the problem is the number will jump to 170 and people will think he made a lot of money, but I didn't. So I feel like that's cheating. So as I'm showing my portfolio consistently every 3 days, I'm not adding any cash. And unfortunately, I'm fully involved. I say unfortunately because I want to sell some holdings. As I was talking previously, like Facebook, for example, I couldn't sell it when I wanted. So I'm fully invested and I'll stay like that for some time, I guess.
In terms of that public portfolio that you actually posted on your channel, right? Do you run a private portfolio where you don't disclose it to the public?
Yes.
You
yes.
do. Okay.
And that part is more exciting because I can play with that more, because many times people have this assumption that, you need to be a long-term investor, you can't sell, but sometimes you just want to play a bit with it. You want to experiment, because if I'm just betting on Microsoft, Alphabet, Amazon, which I am, by the way, you're not growing as an investor because you're not pushing your limits. And unfortunately, if I show it on my YouTube account, people will tell, look, this guy's a trader because he's selling every month. I'm not, I'm just pushing my limits. So these things, I do it privately. I don't share them. It's like 10% of my portfolio, between 10, 15%. And the rest it's available for everyone. You can see how I'm evolving as an investor.
Right, understand. I think I was also toying with this idea of creating a public portfolio, but I'm still too young to have 6 digits under my name. So we are where we are.
Last video, by the way, because you were asking your audience which videos do you want.
Right.
To be honest, the amount doesn't matter.
Right.
The intention matters even more, because what you're telling people is, look, I'm comfortable with my investing skills. It doesn't matter if it's 10,000 or 15,000. As a matter of fact, I'd say it's even better if it's 5,000, because people can relate to that even more. Many people won't make a portfolio of 150,000 and show it every 3 days like I have to. So I also have some pressure on me. But if you have 5,000, you'd be like, YOLO, I'll just put it in 2 stocks and let's see what happens. And if it's good, you get even more views. So from a publicity stunt, I might say that 5,000 is even better.
Right. I think at least on that YOLO, that idea of YOLOing, right? I do understand about this idea of trying to trying to outperform the markets with small caps, etc. But maybe I will explore into how I can upgrade or level up my skills as an investor over time as well. But maybe I wanted to also just pick your brains, right? On this very interesting video that you just released, I think not too long ago. I think a week or two weeks before. And I think the title of the video is called "Why I Will Never Buy Alibaba Stock," and that's the title if you didn't change it, right? So the $1 million question for this entire video is, why do you hate on Alibaba?
Okay, so I need to change the title, I guess. So it's not that I hate, I guess that's a strong word. I dislike Alibaba, let's say it this way. And as I said, when it comes to a business, so you have 3 parameters, at least for me. So it's the management first, then it's the business, and then numbers, and then you have valuation. I think we can all agree that when it comes to valuation, the stock is cheap. Like, we don't have to disagree on that fact. But when it comes to, let's take management, for example. So in the last 2 years, I'd say 1.5, 2 years, we have seen this pattern that many founders exited their business. So if we take Pinduoduo, JD.com, we have Baba, we have ByteDance as well, and many of the private companies as well. So what does that tell you? I guess there's a pattern, and I don't know what that is, but it doesn't give me good vibes. Why would a founder who's actually young, because ByteDance, for example, or even Pinduoduo, these founders are not 60 or 70 years old. So why would someone so young decide to exit, especially when you got the skill you wanted? You were waiting for this moment, you got the skill, and now you actually decide to exit. So that seems fishy to me. I'm not saying it's like something bad, I'm just saying it seems fishy. And you'll need to dig deeper. So that's the first aspect. Then when it comes to the numbers, that's something that disturbs me, because when you check everything except revenue, because revenue is growing, that's okay. But when you take gross margins, you take operating margins, you take profit margins, you take free cash flows, all of them are growing at a slower pace compared to revenue. So that's telling you that Alibaba is growing, but the fundamentals inside it are actually deteriorating. So that's not a good thing. And the last thing was the business model. That's fine. Just the problem is 5 years ago, Alibaba was a platform business. They were facilitating transactions. That's what I highlighted in my video. But now it happens to be such a big business, and they're diversifying literally into everything that comes with lower margins. So if you take the grocery business, the cloud business, the media business, the logistics business, all of them have lower margins compared to your core business. And unfortunately, right now, the core business is not growing at such a rapid pace. I'm talking about the customer management business. If your customer management business is growing at 30%, do whatever you want. It's like Google. You have other bets which in the last 4 or 5 years, they lost $15 billion. Go do it. Your search business is growing. I don't care about the rest. So the margins take care of themselves. Unfortunately, in the case of Alibaba, we have this weird combination that the best business is not growing and your other segments are growing at a faster pace. So the numbers just don't make sense. So that's basically the gist of it.
So basically this collaboration, we actually heard a lot more about how Stockado has positioned himself into looking into Alibaba's business. I will not comment much because there is actually a part 2 and into how me trying to talk into the different pointers and concerns that Saga actually mentioned previously. So if you're interested, remember to stay subscribed and help smash the like button as well. So there'll be a part 2 to this, and then maybe I'll play a short clip, or I will edit it back into it, and we will discuss accordingly. So because this video will focus more about you, right? So maybe we just want to walk through most of my viewers, what's your current portfolio makeup. And I know that you did kind of hinted in the earlier part of this video, but maybe just to provide a fuller context for somebody that is new to you.
Okay, yeah, so more than 60% of my portfolio nearly is 3 stocks. That's hyperscale providers. That's Amazon, Microsoft, and Google. And then I have some semiconductor plays. So here I have KLA, ASML, and Micron. The order is not how I said it. ASML is the biggest, then KLA, Micron. And then I have some Indian banks, which I keep switching. I had 1 or 2. I just play with them. But it's HDB and ICICI Bank. I switch them whenever I feel like HDB is going to do better than ICICI Bank.
Right. So
Facebook. Sorry, I forgot that.
Right. Plus Facebook. Okay. But Facebook, I believe you have actually trimmed the position down and you're intending to exit sooner.
Yeah. So I reduced it a lot last year, October, November, when they mentioned they're going to spend around $10 billion on the metaverse thing. I trimmed it by 70%. I shared it on YouTube, and I kept a 3-4% position. So that's what I have right now.
From when I look at the entire portfolio makeup right now, right? You have a congregation into big tech and semiconductors, right? So your Microsoft, Google, Amazon, those are your big tech, and then your AML and stuff like that. So I wanted to break it up into 2 discussion points. So we'll talk first about big tech companies. So I believe it's the darlings of Wall Street. I think they've outperformed over the last 5 to 10 years. The returns are just incredible, and for it becomes the foundational bedrock for most retail investors portfolio, right?
Sure.
You have people having Apple, Microsoft, Google, whatnot. I think personally, I'm currently dabbling into big tech as well, or trying to look into the business in a much deeper and on a much fundamental level. And I can't help but to come across a few pointers maybe that you can help address as well. So I think firstly, there is this idea of earnings expectations being off whack. So I think the biggest problem that first came up, the signs of such issues really came up when Snapchat reported a revision in terms of guidance, and you see Google and Facebook pang alongside. So then recently also, Microsoft also revised their guidance downwards, like just a few hours ago. So in that case, maybe if we break it down, what do you think of these earnings expectations? And do you think it's the start of the downhill of every single big tech companies just slowly revising downwards, especially when we see so many recession scares telling how the economy is going to slow down, etc., etc.? What are your views?
Yeah, so nice question. And if I convince you to buy, will you buy one of these 3 companies?
I actually am already doing my due diligence on Microsoft and Google, but Amazon is a lot harder to look into because the free cash flow numbers, the PE, whatever. But I'm doing my homework. But yeah, I'm always open to listening.
So let's see if I can convince you. Because all the 3 companies, in reality, I can't just talk about all of them in one sentence. So I'll just separate them into 3 companies. Let's start with Microsoft first. When you take a look at all these SaaS companies out there, you'll see the valuations simply don't make sense, because they're very expensive. Now, Microsoft, on the other hand, inside Microsoft itself has several businesses that are growing at 30 or 40%. So if you take cloud, for example, it's growing in double digits. If you take the gaming business, it's also growing in double digits. And they have LinkedIn, for example, is growing by 30 or 40% every year. It makes more money than smaller companies like Pinterest and any other public company. advertising businesses. Now, in the case of Microsoft, the good thing is, let's imagine that we do see a downturn, which eventually we will. Well, the company has a lot of cash on their balance sheet, so they can actually survive. That's first point. And secondly, you should also remember Microsoft is smarter now because the business is evolving. So they are switching to annual contracts. So if you take Office 365, for example, there's a monthly option. But now what they did was, because this happened to me as well, they sent me an email. They said, look, if you stick with your monthly plan, we'll increase this by 20 or 30%. But if you switch to the annual one, the price remains the same. So what they're doing is they're switching the entire business to annual contracts, and they have a decent backlog. So this gives you some visibility. That's why they can give you the guidance and always hit it. So if you check the last 4 or 5 years guidance, they have mastered the Wall Street game because they'll sandbag the numbers first, and then they'll beat by 10%. Miraculously. And if you check the guidance which changed today, it was only thanks to FX impact. And secondly, as I told you, if you check the last 5 years, they always hit the guidance. Actually, they increase it just a bit. So in any case, Microsoft is playing the Wall Street game, which is, look, we'll sandbag your expectations and then we'll hit it out of the park again. So that's Microsoft. So let's go with Alphabet now. It's not the same as Microsoft because when it comes to revenue, it's a bit like Alibaba. It's growing every year consistently as all the businesses are growing. The problem happens with their income, because Alphabet has the advertising business, which is profitable. That's with YouTube Premium and YouTube ads as well. But then we have other bets and cloud. And the problem is whenever you see a downturn, like now, for example, NASDAQ is down by 20 or 30%, unfortunately, that drags down all their investments, including other bets. So the operating income does take a hit, and net income as well. Now, the only good thing is right now, Alphabet has a PE of what? It's in double digits. I think it's between 17 to 19.
Yeah.
So what will happen is, as they have a decent buyback program of $70 billion, they can simply buy back more shares and boost the EPS. So what will happen is revenue will grow by 16-70% if you're conservative, and I'm not including so much of cloud there, but then the EPS can easily grow by 20 or 25% because you're buying back shares consistently. It's something like Apple. Because remember, in the last 5 years, Apple didn't grow its revenue. What happened was the EPS kept increasing because of buybacks. So Alphabet can do exactly the same. They don't need the cash. 5 years ago, they couldn't do it because they needed to spend so much on cloud. It required a lot of infrastructure, so the capex amount is very high. Now, it has actually maintained it. In the last 2 or 3 years, you can see it hasn't increased so much. And that's why they can buy back more shares, because now all the businesses will become profitable, cloud included, of course.
Right. So if I actually wanted to push you a little bit more into this earnings expectations, right? So I recently, I was sharing with my audience the other time where there was this recent video by Professor Damodaran. So it's the Dean of Valuation. So he was projecting a whole range of different expectations in terms of interest rates, earnings expectations, and how much to discount, what to discount, etc.
Sure.
And looking at the current markets and the based on his theoretical values that he came up with, the current market is essentially just pricing in rate hikes and probably QT, which is quantitative tightening. Yes. In terms of, if you look at, because he was coming out with different variables, right? If you look into the variables of maybe a negative 10%, a negative 10% earnings expectations or negative 20%, we are far from those numbers. So it does seem like the market is not pricing in any forms of recession, slowdown, etc. And the companies will continue performing at their 20-30% clip. So if that's the case, right, if it doesn't play out in that, from that perspective, what's going to happen to all these different big tech companies?
So you're saying like if everything goes south, what will happen?
I wouldn't say, because we are currently now in a few different stages, right? We can only guess what is the probable scenario. Of course. So if I can ask you from your perspective, what do you think would be how would you quantify the different scenarios in the coming?
Well, it comes to odds at the end of the day. So if you have a company that has a PE ratio of 50 or 60, well, obviously that's going to take a hit. Now, the issue is if you take a company like Alphabet, for example, it had a PE ratio of 22. Now it's at 16 or 17. What, we bring it to 10? We bring it to 5? Then where does this go? So it seems like tech companies did take a hit, but it seems like not all of them actually they didn't deserve it. So if you take, for example, Microsoft, it's growing at 13 or 15%. And as I said, Alphabet also has a backlog, by the way, of 50 or 80 billion dollars approximately because of cloud. So if the company has a backlog and I have visibility, why should the stock go down? I'm not saying you shouldn't go down. I'm saying is you shouldn't go as down as other companies that don't even have a profit. So I'll give you some examples. Like I mentioned, the semiconductor industry, you have those companies. So if you take ASML and KLA, they're booking orders for 2024.
Right.
So I already know what's going to happen this year, the next year, and they have orders for 2024. Now, a company like that can't go down by 50%. And that's exactly what happened. So if you check the entire semiconductor industry, some companies like NVIDIA, AMD, they went down by 50%. But a company like KLA only went down by 17%.
Right.
You can't take that company down because they're telling you what they're going to make. So it simply doesn't make sense.
Right.
In the case of ASML, it had a very high PE ratio of 50. And on my channel, I don't like to hide these things. So I openly told everyone, look, I'm paying a premium just so you know, I'm not hiding this.
Right.
And of course, the PE ratio came down. So it went from a PE ratio of 50 to approximately 35, something like this. But they have really high margins and it's a monopoly business.
Right.
So yes, the market can take a hit. It should take a hit if we face a recession. But in that case, you should sell everything. Like if you are thinking that you can't take a 20% hit on your portfolio, which I already did, by the way, in that case, I'd say either you just buy index funds because investing is not for you, and that's fine, or you can just sell everything if you're not comfortable and then see what happens. Because at the end of the day, we are simply managing odds. So on my Twitter account, I just keep telling, look, this is what companies are telling you. So if you take Salesforce, for example, or yesterday, another cybersecurity company, they announced their numbers. They said, look, we have a decent order book. Everything is fine. We're not seeing any issues. The only thing we will see, and this is happening already, is the demand is shifting. So it's not that the demand will be very high for iPhones or MacBooks every quarter consistently. The demand is switching. So for example, if you take luxury companies, like I've also talked about them on my channel, like LVMH, Hermes, these companies are booming. They used to grow by 10 or 15%. They're growing by 50%.
Right.
That's not a joke.
Once China is out, they're gonna grow at 70%. But as this is famous last words when China comes back out.
I 100% agree.
Right.
Because if you take a company like LVMH, and this has to do something with accounting as well, because LVMH reports 40% of the earnings from China. Just the problem is many people in UK also buy their Chinese. Because there are some tax advantages as well. So in reality, I would say 50 or 60% of the business actually comes from China.
Right.
So when someone was asking me the other day, how can you actually invest in China, which doesn't have to do with tech, because we can see government is actually trying to control them indirectly. So in that case, LVMH, Hermes, all these companies, they actually make money from China. They are profitable. And you're not going to regulate handbags, are you? Like, there's nothing to regulate there. So
we never know. But yeah, I get where
that's
you're
true.
from.
That's true. We never know at this point. So,
right.
But yeah, that's my approach at least.
Right. Maybe also, I think you picked out a very interesting point. I think you mentioned about valuations, right? When we look at Google, they actually dropped from probably 20 odd. Now they're trading at probably high teens. So then you then went on to say how low can it go? 15, 10x. I think that's one of my major concerns as well on what if there is this new revaluation in terms of the big tech companies where they say that, oh, the average is 15. And then for Facebook, because it's probably lousier than its peers, they're going to trade them at 12 or 10 for that matter. So these are just arbitrary numbers. Because when I really look back into how the price has performed for a lot of these big tech companies, right? When we triangulate then from the 2020 before the COVID crash, so from then until now, I think Apple is up around 80-odd%. Microsoft is still up 40%. Google is up 50-odd%. So if we took a CAGR of that 2.5 year time frame, the CAGR is still 20-30% in north of 20-30%. So that's still incredible performance, by the way. I'm not gonna lie that, because on average the S&P is supposed to only return 8 to 10. So in that case, there are also many discussions online on saying that, oh, it might be a lost decade. We might already reach in one of the peak valuation periods. And also it doesn't help when a lot of all these big investors at Ray Dalio say, oh, the expected investment time horizon for the next 10 years would probably return you around 4 to 5% only. So actually, what are your views on these? And do you think tech will continue dominating, returning a CAGR of at least 15 to 20% in the coming decade?
Yeah, well, if it does 15%, we'll retire in, I would say, 10 years, right? We don't even need to make videos. But regarding tech and Ray Dalio, so when it comes to Ray Dalio and Bridgewater, the approach is very different from us, for example. We want to maximize returns. In his case, it's just to lower your risk.
Right.
So if you take Bridgewater returns for the last 10 or 15 years, it underperformed literally every year. Because the goal was not to give you returns anyways. It was just to protect against inflation and just lower your risk. So that's regarding Ray Dalio, but he's always negative, by the way. But even last year, he was telling you cash is trash, and now he's telling you. So I get confused. Like, for example, yesterday I tweeted about Jamie Dimon. Last year, he was telling you the economy is booming.
Exactly.
So next 10 years, we'll grow by 5 to 10% every year.
Right.
Then he's telling, guys, there's a headwind, like a small recession.
hurricane.
Like, well, just make up your freaking mind, because 2 years ago, and here's the best part, because when it comes to shareholders of JP Morgan, for example, 2 years ago, I'm sure you remember, everyone was telling you should buy banks, interest rates are going to rise.
Right.
Here's why this thesis doesn't make even sense. So if you take 2 years ago, when the interest rates were pretty low, Jamie Dimon said, look, we are not giving out loans because we think interest rates are going to rise. Makes total sense. So they had around $500 billion on their balance sheet. I'm fine with it. And now he tells you, guys, we're not lending because, you know, we might see a recession, even though consumer spending is extremely high. So for the next 2 years, you add the previous 2 years, next 2 years. So for the next 4 years, the bank is not lending so much.
Right.
Now, as a bank, your net interest income is your biggest income. Right. So for 4 years, your income is flat, and everyone was telling you should buy banks. It turns out it was actually worse than tech. So if you take JP Morgan, Bank of America, check the returns compared to Google or Microsoft or Apple, you'll see they actually fell more than actually tech.
Right.
So that's why it makes sense that you compare what's happening in the entire industry. Don't just believe Jamie Dimon or Ray Dalio. At the end of it, it's your money. So you need to think independently. And regarding tech, you said, like, can we see like a big crash or something? Look, at the end of the day, we can see anything. I'm not going to predict anything. But if a company has a P ratio of 15, there's not much to lose. But like Alphabet, for example, just saying, or not cloud, just tech in general. It's not like an accessory, it's a utility. So if you take cloud, for example, we are having this Zoom call and we want to storage, like if I make 10 videos, I need storage, I need memory. Well, you will use cloud eventually. So it's becoming a utility because it's so cheap. Right. So when you take several services, I would consider them as essential. It's not an option anymore.
Right.
So cloud is one option, like semiconductor is another option. All of them, they're really important. You can't skip them. I'm using my MacBook, pretty sure it has like, what, 10 or 15 pieces of semiconductor inside it, pretty sure even more. So at least the bets I have, they're really essential industries. I don't have consumer industries in my portfolio. I just have one. I keep switching that, and that's LVMH. And I would say even that is not an accessory. It becomes a utility, because when people have a lot of money, they're like, look, I need a Louis Vuitton bag. I can't buy a shitty Zara bag. I need a Louis Vuitton one, or your one. So So most of my companies have backlogs. They're essential industries, B2B. It's pretty boring, but at least I don't need to worry about the next day, how the demand is going to be.
Right. So maybe I think you have been hinting on multiple occasions about Alphabet's current valuation. So then I wanted to pivot over to the question. So what exactly is the market missing by granting them such a low valuation currently, in your own personal opinion?
It's not missing anything, actually. So if you check the last 4 or 5 years, you take between 2017 to 2020, you'll see Alphabet didn't give you any returns. Now, it's not just the stock performance, actually the business also reflects it. What was happening was revenue was growing at a decent pace, but you'll see gross margins were down, operating margins were down, net income didn't grow as fast as the revenue. So what's happening was the fundamentals inside the business were actually deteriorating. And that's mainly because of other bets and cloud. Remember, both of them, they have a very high gestation period. Cloud takes a lot of CapEx, and obviously free cash flows also take a hit. So it makes sense the stock doesn't move, because everyone is telling this guy, Sundar Pichai, is investing so much into these businesses. We're not seeing any returns. So why do we reward as shareholders? And you see the same thing with Amazon. In the last 2 years, as the CapEx was so heavy, free cash flows were not even there. They were actually negative. Why would we move the stock? And the stock didn't move.
Right.
But now, if you check after 2020, you'll see a different phase in Alphabet, and I've highlighted this. You'll see margins are higher than the previous 5 years. And it's very easy to understand this, because now cloud doesn't need CapEx. Cloud will eventually become profitable in the next 2 or 3 quarters. As your search business becomes so big, the other bets category becomes smaller and smaller. The proportion changes. So let's take search as, let's say, 80 or 90%. It's not just advertising is 80 or 90%. Your other bets losses, they keep shrinking and shrinking. So that's why your margins simply improve. So my bet in the case of Alphabet is margins are going to improve, and the EPS is going to grow at a faster rate because of buybacks. And we can see that happening. So if you check in the last 6 or 8 months, Take the tech businesses, take Snapchat, Pinterest, take Facebook. Now compare Alphabet's returns to all these other companies. So you'll see that all these companies fell by 40, 50, 60%. Alphabet fell by 20%.
Right.
So from all the tech sector, if you take the 3 best stocks that didn't lose so much money, it was Apple first, Microsoft, and Alphabet.
Right.
So as far as I'm concerned, since I started investing, my thesis is playing out that the stock is becoming better. It's not just the business model, but at the end of the day, we make money only when the stock goes up. So ideally, I want a stock that goes up quickly, and when the market goes down, it doesn't fall as much as the market.
Right.
Because in my case, I need to report my my portfolio number every 3 days. So I just want to make sure I do everything correctly and I have that pressure. So that's why, as far as I'm concerned, Alphabet is doing exactly what I wanted to do.
Right. Actually, just interestingly, when you were explaining the discussions on previously on what has been transpiring for Alphabet, right? It sounds very much like what Alibaba is doing, but yeah, it's a discussion for the next video. So maybe also on one last part on your portfolio, right? When you talk about industries like semiconductor, I think the first that I see when you invest in semicon, but you don't have a position in Taiwan Semiconductor. I believe you would know that particular company. So are there any thought process behind why you didn't own TSMC? Or
but when it comes to Taiwan Semiconductor, I like it. Just in my case, the semiconductor bet was really specific because I wanted something that had some visibility. It's not like I like the entire sector. For example, I wouldn't invest in a company like Nvidia, even though everyone loves it. If you take a look at the stock price, and 4 years ago, I never used to talk about the stock price because Warren Buffett tells, look, you should only focus on the business fundamentals. But at the end of the day, we are investors and we only make money when the stock moves. If you take a company like Nvidia, it falls by 50% every 3 years. I don't want to deal with that headache. Simply, I just don't want to do it. And there's a good reason behind that. If you want, we can talk about it. But check the Y charts. See, every 3 or 4 years, the stock will go down. 2017-18, it again went down by 50%. And by the way, there was no good reason behind that because the business only, I think it just stagnated for 2 years. But yet the stock went down because for some reason. We can talk about that in another video if you want to.
Right.
But in the case of Taiwan Semiconductor, well, I just don't like it. Like, it's a great business, but as a stock, it's not good.
Right. Is there any particular reasons on why as a stock it's not good?
Yeah, well, because there's always the China risk.
In China, right? Okay.
About that. And no, but there's also Taiwan Semiconductor can't grow at 40% every year. It just can't happen because what happens is in the case of AMD and Nvidia, for example, they're betting on the data center business. Apple, AMD, Nvidia, they are the biggest clients, right? So they're betting on the data center business. Now that business doesn't grow by 40% every year. It grows by 20%, then 3%, then 20%, like that. So Taiwan Semiconductor grows by 20% in a good year, then 15%, then 20%. In my case, the semiconductor bet I have is I know these companies, KLA and ASML, they can grow by 25, 30% for 2 years, and then I'm out. I just played the cycle. That's my plan. I don't plan to hold these stocks for 10 years because we'll see these cycles. So it was just an interesting bet because I never invested in the semiconductor industry. And if you check fundamentals, you'll realize that KLA actually has better metrics than most tech businesses as well.
Thank you once again for the different insightful sharings and all the entire discussion surrounding big tech. Maybe I just wanted to kind of close up the entire discussion. And I think this is one of the most common questions I ask all the different guests that I invite onto my channel as one of the closing thoughts. So I wanted to understand what currently keeps you up at night.
Well, I just love studying businesses.
Right.
At the end of the day, stock prices, like, yes, you make money and stuff, but at the end of the day, in let's say 5 years down the line, you just want to be smarter so you can invest better. So, and you can only do that by studying businesses. You can watch videos, you can pick my brains up, but that's not going to help you because you won't be able to apply that when you need to. And right now we have a limited capital, but let's say after 10 years, you have a bigger amount. So you need to be smarter so you can manage that. So studying businesses, that's the best thing you can do. And even if you don't invest, by the way, you should still study businesses because you can see what other people are doing. At the end of the day, you are making money somehow, right?
I think it's not only on YouTube. I think in other facets of your life, whatever, when you look into strategies of different companies, how they position themselves, it will probably benefit you in your own life and how you position yourself in the workplace. for example. So that's just one takeaway that I gotten, and some very interesting insights that I've got when I actually look through some of the companies that I study as well. So I think last part on this entire video before I close off, do you have any advice for all the Alibaba bag holders on my channel?
Yeah, every loss, if you don't learn from it, it's a pathetic loss. But if
Right.
you can actually learn from it, it's a lesson. It's not a loss anymore.
Right.
So we all have stocks that fall by 40 or 50%. The question is, how can you avoid it? And I'll give you a simple tip. If the stock falls by 30%, sell it.
Right.
So because someone asked me the other day, look, how can I avoid 50% losses? And at the end of the day, it comes back to your personality. If you can't handle a 40% loss, just put a limit at 35% and be okay with it.
Right.
So if Amazon is if Alibaba, is down by 30%, I sell it and let's see what happens. Most of the time, if the business is decent, it actually comes back.
Right.
But at the end of the day, most of the time people focus on the wrong metrics. We never focus on what's moving the stock. Because when you're analyzing a company like Alibaba or Facebook, for example, if I ask you, do you think Facebook should be down by 50%? Does it deserve that?
Currently, I don't think so, but that's how the market has been treating them. But
yeah.
I mean, I would definitely agree to the fact that they should be punished, but not to this current extent. But however the market trades, I will intend to continue building a position if that was my initial game plan in the first place.
Yeah, exactly. So with certain stocks, if you don't know what's moving them, maybe it's better to avoid it for a while. Like in the case of Amazon, many people say, why isn't this stock moving for 2 years? And I'll give you a simple answer. Take a look at their free cash flows and you'll get the answer why the stock is not moving.
Right.
So in the case of Facebook, for example, it doesn't have to do with a revenue. Revenue is growing at a decent pace. It has to do that the revenue is slowing down and margins are already taking a hit. So if you compare the margins like 2 years ago, it was a platform business, nice advertising platform business with very healthy margins. Now, the goal of a tech platform business is you grow your revenue and your bottom line grows at a faster pace because you gain operating leverage. In the case of Facebook, we see all the opposite. The business is growing, but the workforce is growing faster than revenue. So margins are taking a hit, and that's what's driving the stock down, together with the revenue deceleration as well. So at the end of the day, if you don't know what's moving the stock, maybe you should just stay away from it for a while, because when the stock goes down by 40%, you don't know what to do because you were tracking the wrong metrics. So
insanely, I think for people that were discussing about Alibaba specifically, because when we look at the stock chart, right, if you pull it out for 5 years, I think it didn't move at all since its IPO because it's back to IPO price. So then comes the question on discussing Warren Buffett say, if you don't intend to hold it for 10, you don't intend to hold it for 10 years, don't hold it for 10 minutes. I think this kind of conventional investing wisdom, I think it's quite nuanced in their own thinking, because there are different strategies and different how you position yourself as an investor.
Of course.
Everyone has different temperament. So so I think personally, at least for myself, I always like to ask this question because it's an interesting way to kind of end.
Can I just add one thing here?
Sure.
Because you mentioned something so interesting. You talked about Warren Buffett. So just to give you some examples, because when everyone starts, we think Warren Buffett is the best investor out there, and I still think the same. But don't just take their word. I'll give you a nice example. So when he tells, look, we buy a stock and we plan to hold it for 10 years, if you check the last 3 or 4 years, the churn ratio is actually exceptionally high. He had banks, he sold it. He had the aviation sector, he sold it. He had Oracle, I believe, he sold it. He had IBM, he sold it. And like a Walmart, he sold it. So I can go on and on. And if you check when he had his fund, for example, he had a churn ratio of more than 50% when he was managing his own money. So now I'm not telling please don't trust Warren Buffett. He's the best investor out there. What I'm saying is you can learn from everyone. Just don't take their word, because at the end of the day, if something goes wrong, I plan to sell my stock. I don't want to, or I don't need to prove you that I'm a long-term investor. I need to focus on my returns. I don't have $50 billion like Warren Buffett. Like he can hold his mistakes and be just fine. I'm not in that position, unfortunately, right now. Hopefully one day we'll both be in that situation. So just don't take anyone's word, because it can be really, really dangerous.
Yeah, I think usually things are also put out of context, and then when people ask you to buy when the market is fearful, I think a few months back, I was thinking, are we really in fearful territory? I'm not too sure, but But if the fear index says so, I think we're in fearful territory. I guess that's how people quantify.
I'll tell you, if a
quantify that.
stock like GameStop or AMC is still doing fine, we are not in fear territory.
Right.
Like it's pretty obvious. If shit, I don't want to take the name. If I take the name, I'll get some heat. Or
Right.
okay, I'll do it anyways. We might get you some likes and clicks here. If you take a company like Palantir, for example, it doesn't make sense it can still have this valuation when they still didn't show you profitability.
Right.
The business is growing. I agree. It's growing at 30%, but then you have a company like Alphabet, which can easily grow at 25%. It has a P ratio of 15.
Right.
So how do you justify that gap? So when you say, for example, I'm in the fear territory, I can already tell you no, because you can see some valuations that simply don't make sense.
Right.
So maybe in the next 2 months, we have this conversation again and we can revisit the thesis. But at least right now, it seems like we are fine, at least right now.
Right. Okay. Thanks again, once again, for coming onto the channel. Was greatly appreciate all the different insights that you actually shared to my audience. And maybe you can do a follow-up video again into seeing how well actually both Palantir and Alibaba is performing in time to come.
Yeah, of course, Sam. Thank you for having me once again.
Thanks, Stockado.